Stop everything you are doing right now because something historic just happened. While the mainstream financial media was busy telling you to stay in stocks and trust your 401k and believe in the system that has been robbing you blind for 50 years. Silver has officially reached $100 per ounce and gold is getting ready to smash through $5,000 per ounce. And I would not be surprised if that happens the moment markets open Monday morning in Asia, which is Sunday night here in the United States. This is not a drill. This is not speculation. This is not some conspiracy theory from people wearing tinfoil hats in their basements. This is the cold, hard reality that both gold and silver are repricing themselves against debasing fiat currencies that central banks around the world have been printing into oblivion for decades. And here's the part that should make every single stock market investor sit up straight and pay attention, because gold and silver are now officially outperforming the S&P 500, not just over the past year, but listen to this very carefully. Gold and silver have gained more in 2026 alone than the S&P 500 has gained over the entire last 12 months, excluding dividends. Let that sink into your brain for a moment. The metals that Wall Street told you were dead money, the metals that financial advisors told you had no place in a modern portfolio, the metals that mainstream economists laughed at and dismissed as relics of the past, those exact metals are now crushing the most celebrated stock index in American history. The people who listen to the establishment are watching their purchasing power evaporate, while the people who understood what was actually happening are building generational wealth in real time right before your eyes. Now, for the people who are relying purely on stocks or their American 401k retirement accounts for their future security, what is happening today is starting to look frighteningly similar to the period between 2000 and 2012 when metals experienced a massive historic bull run that absolutely demolished the stock market in terms of real returns. During that 12-year period, gold and silver each gained roughly 500% on an average price basis, while the S&P 500 was actually down 3% and only up 26% when you factor in dividends. Think about what that means for the average American worker who trusted their financial advisor and kept pumping money into their retirement account month after month while precious metals were quietly multiplying 5 times over. And with the S&P 500 currently breaking down against gold priced in real terms, every intelligent investor is now wondering if we are about to see a repeat of what happened between July 2005 and September 2011 when money rotated aggressively out of the stock market and flooded into gold and silver with devastating consequences for anyone caught on the wrong side of that trade. In 2011, only 0.7 ounces of gold could buy the entire S&P 500 index, which from today's level of 1.4 ounces means gold could still double from here to $10,000 per ounce, even if the S&P 500 remains completely stable. And if that happens, silver at a modest 40-to-1 gold to silver ratio would be sitting at $250 per ounce. This is not fantasy. This is not wishful thinking. This is the mathematical reality staring you directly in the face while your financial advisor tells you everything is fine and to stay the course. Now, there is a man named Gary Savage who has been making the rounds on financial media claiming that we are in the final 6 to 12 months of the gold and silver bull market and that anyone buying metals now is going to end up with massive losses once the inevitable crash comes and silver falls back to $50 per ounce. His argument is that the bull market started in 1999 and that stories about major changes in the monetary system are being blown completely out of proportion. And I am here to tell you that Gary Savage gets it wrong from the very beginning because the real bull market for precious metals did not start in 1999. It started in 2002 when real interest rates measured by the one-year U.S. bond rate minus official inflation went negative for the first time since 1980, and the United States government once again showed its true colors, proving it could not manage money responsibly. This kicked off a clear 10-year bull market, followed by 8 years before gold made a new all-time high, and 14 years before silver broke out, which establishes a definitive break between the bull market of the early 2000s and the bull market we are experiencing right now today. The current bull market arguably started in late 2019, when the Federal Reserve stopped shrinking their balance sheet and started printing money again, just like they are doing right now in December of this year. So based on historical patterns where bull markets lasted 10 years each, this current gold and silver bull market could easily last until 2028 or even 2033, meaning we still have anywhere from 3 to 7 more years left in this bull run. Gary Savage may end up selling at the first pause and regretting it for the rest of his life. Now, even though I believe the biggest moves for gold and silver are still ahead of us, you need to understand that all bull markets have pauses along the way. We saw it in 1975 and 1976. We saw it in 2008 when the financial crisis brought metals down temporarily. And we saw it again in 2022 when central banks raised interest rates. A bull market does not have to be a straight shot up to the moon, but there are 4 specific indicators that tell us when the real top is actually near. The first indicator is the gold to silver ratio crashing, which shows how many ounces of silver it takes to buy 1 ounce of gold, and this typically drops 60% before a major top reaching levels around 40 or even 32 like we saw in 2011. This is currently happening. The second indicator is a significant decline in the US dollar on the DXY index, which crashed nearly 30% leading into the 1980 top and a whopping 40% leading into the 2011 top. Currently, the dollar has only declined 16% from its 2022 high, which means this criteria has not been fulfilled yet, and we should expect the dollar to drop to at least the 81 level or lower. The third indicator is U.S. interest rates reaching their absolute lows, which has not happened yet, as the Federal Reserve plans to continue cutting rates at least 2 more times in 2026, while simultaneously using quantitative easing to buy bonds. The fourth indicator is a major market event like a recession or financial crisis, which brings us to what is currently developing in Japan right now. Until all 4 of these indicators align together, calling the top of this bull market is premature. Now, what might accelerate the move down for the dollar and force interest rates back to 0% is the final thing we typically see before a metals market top, and that is a major crisis. And we may be getting exactly that coming out of Japan right now. This is a topic that keeps getting worse as time goes on because rising interest rate yields on Japanese bonds are pushing the country dangerously close to a complete financial meltdown. Japan's debt currently stands at more than 200% of the country's annual economic output, making higher taxes completely insufficient as a solution. Even worse, Japanese banks and insurance companies that own these bonds are sitting on approximately $80 billion in unrealized losses, which is frighteningly similar to what caused Silicon Valley Bank and other regional banks to collapse in 2023. And here is the connection that most people are completely missing. If the European debt crisis in 2010 and 2011 was enough to trigger a massive blow-off top for gold and silver prices, consider the fact that the Japanese problem we are facing today is nearly twice the size of what we dealt with in Europe back then. Japan is the largest foreign owner of U.S. Treasury debt, holding more than $1.2 trillion worth. If things get really bad in Japan, and believe me when I say they are dangerously close to getting really bad, they will be forced to sell a massive portion of their U.S. Treasury holdings to prevent their own financial system from sinking. This means problems in the Japanese bond market could easily spread to the U.S. bond market and crash the U.S. dollar simultaneously, as investors and central banks around the world are already hedging their exposure to American assets. With the first phase of this gold and silver bull market now officially behind us, and the conservative price targets that were shared back in September already achieved, it is time to shift focus to the aggressive scenario with new minimum targets that will make your head spin. The new minimum target for gold is $7,500 per ounce, and the new minimum target for silver is $150 per ounce based on detailed technical analysis and historical patterns. But here's what you need to prepare yourself for mentally, because this journey will not be a straight line. There's a high possibility of seeing a correction before we reach those levels, which for gold may happen as it breaks into the low to mid $5,000 range, and for silver somewhere between $120 and $130 per ounce. This would represent the upper part of the previous conservative range and the lower part of the aggressive range. The reason I mention this is to prepare you for potential volatility and to make absolutely certain you do not mistake a temporary pause for the actual top. Because from my point of view, if you give up during a pullback, you may end up regretting it for the rest of your life. Just like the people who sold their silver at $40 and $50 per ounce are kicking themselves today watching it trade at $100. The worst thing you can do in a bull market is sell during a correction thinking the sky is falling, when in reality the market is simply taking a breath before the next leg up. Keep your eyes on the prize, which is $7,500 gold and $150 silver at minimum, with potential for significantly higher prices. Now, some people are worried about a massive crash like we saw after the 1980 and 2011 tops, but what we are facing today is fundamentally different, and here is exactly why. After those previous tops, speculators who had driven up silver prices faced a harsh reality, because although they could eat up large amounts of supply temporarily, not enough of the metal was being consumed by industry to keep the market off balance for very long. In 1980, the U.S. government started selling its 165 million ounce strategic silver stockpile, which made manipulation easy. Silver was no longer used in coins and supply was abundant. These conditions remained even after 2011, with silver in surplus 7 out of 9 years following that top. But by 2019, everything started to change dramatically. Where silver was once abundant, now it is being consumed by industry at unprecedented rates. Solar panels, electric vehicles, smartphones, military applications, and countless other technologies require silver, and mine production has remained relatively flat. This is precisely why the United States has designated silver as a critical mineral, and China has imposed export controls preventing the metal from leaving the country. The U.S. government is now secretly stockpiling silver, needing between 250 and 500 million ounces to secure a 5 to 10 year military supply. The supply deficit is persistent and growing every single year. Talk of a crash back to $50 per ounce is completely delusional, with a strong price floor for silver currently standing at $72 per ounce. This is not 1980 or 2011 repeating itself, because the fundamental supply and demand dynamics have shifted permanently in favor of higher silver prices for decades to come. Now let me tell you about what happens after this current bull market takes a pause, because the story does not end here. Unlike Gary Savage, who thinks the US dollar system will simply carry on because a growing economy supposedly needs inflation to thrive, I believe there is absolutely no coming back from the move into gold that has been put into motion globally. Central banks around the world are accumulating gold at record pace, with Poland just announcing they will add another 150 metric tons to their reserves, even at record high prices, taking them from 550 tons to 700 tons. This behavior is spreading as major institutions make irreversible moves out of the US dollar, the euro, the yen, and other fiat currencies. And here's the catalyst that almost nobody is discussing publicly. The US Social Security program and other national pension programs around the world are running out of money. By 2033 at the latest, the United States will face a critical shortfall in Social Security funding, and that money will be printed to satisfy voters who will absolutely refuse to accept cuts to their benefits. This printing event will be the catalyst for the next major leg up for metals heading into 2040, a 20 to 30% drawdown in gold and silver prices like we saw after the dot-com bubble is possible once this current phase pauses, but that should not concern you. Pullback levels around $6,000 for gold and $140 for silver would represent a worst-case scenario, not a crash. This thing is going to hit entirely new levels once we get past 2033 and the money printers really start moving. The gold and silver bull market of a lifetime is just getting started.